When it comes to the rupee, the public is a bit like the Khadoos Indian dad who sits in the living room with a newspaper and has to compulsorily say something mean the moment you walk in. It could be about your marks, your career, your life choices, but the sarcasm is so lethal that your whole self-confidence will crumble down like Parle G in tea. Case in point, Bollywood actor Juhi Chawla's tweet in 2013, which is again becoming popular now. Thank God, अपन के अंडरवेयर का नाम डॉलर है. Rupee होता तो बार बार गिरता रहता. Referring of course to an underwear brand in India called Dollar. The fact is that people look at the rupee constantly depreciating, which is now in fact crossed lifetime lows of more than 85 against the dollar, and they are like, हमारा बेटा तो failure ही failure है. Amplifying this sentiment are the army of YouTubers and finfluencers who do this ritualistic chest beating out of agony whenever the rupee falls. But here's the thing, the question is not whether $1 can be exchanged for 80 rupees or 85 rupees or 90 rupees. The real question is, how much does it actually buy? So if US tourists were to come to India, exchange $1 for 85 rupees here, will they be able to buy the same amount of stuff that they could buy with $1 in the US? The answer is no, because the price levels are different in the US and India. So the exchange rate actually has to be adjusted for the relative inflation between the two countries, which is why economists have devised a measure called real effective exchange rate, which is the exchange rate adjusted for the difference in inflation between the two countries. And this is done not just with the US, but with India's top trading partners. It's aggregated and converted into an index, so the base is 100. So 100 would indicate that the actual current market exchange rate is correctly valued. If it is above 100, as is the case for India, then it indicates that currently the exchange rate is overvalued. This means that the US tourists who exchanged $1 for 85 rupees will go to an Indian market, see the price labels, and realize, hey, I should have gotten 90 rupees, not 85 rupees for that $1. So accounting for inflation, it is estimated that the rupee is overvalued by as much as 8% currently, which means that even though the rupee-dollar exchange rate is at record lows of over 85, the depreciation means that it's still relatively stronger compared to our other trading partners, making our exports more expensive compared to them. And this shows when you look at how much the rupee has depreciated in the last 3 months. At the time of filming this video, the Indian rupee has depreciated by around 2.5% against the dollar in the last 3 months. The Chinese yuan in comparison has depreciated by nearly 4%, the Thai baht by around 5%, the South African rand by over 8%. So the rupee has actually been among the best performing currencies of the lot. And this is not by accident. Have a long, hard look at the chart of the dollar rupee exchange rate, and you will notice something odd going on. Because until around 2022 or so, the exchange rate would go up and down. But from 2022 onwards, it has been remarkably stable. It's like a normal kid that was jumping up and down, crying one moment, laughing the other, suddenly became depressed and emotionless in the last couple of years. So what on earth is going on? Hello and welcome to The Bond Economist, your one-stop destination for professional advice on the economy. My name is Auradeep Nandi, and today we talk about the rupee. Why has it been depreciating? How is it being manipulated? What are the compromises we are making as an economy in trying to manipulate the rupee? And what could happen next? As always, if you like what you see, please hit like and subscribe. And if you'd like to contribute to this startup channel, please hover your phone on the QR code here or use the super thanks button below. First things first, why is the rupee depreciating? Like a seesaw, when one side goes down, typically it's because the other side has gone up. So one important reason why India and other emerging markets have been seeing their currencies depreciate is that the dollar has become stronger. The dollar index, which is the value of dollar against the basket of other currencies, has surged by over 7% in the last 3 months. And why is this the case? Now, in the second half of 2024, inflation in the US started coming down and unemployment rate started inching up. In fact, at one point, almost reaching levels that were associated with the start of recessions. The US Central Bank, the Federal Reserve, was convinced that the sky-high interest rates that they had in place after the pandemic to control inflation was now finally starting to impact the economy. Inflation was coming down, growth was showing early signs of slowing, and so the Fed started cutting interest rates. But kahani mein twist tha. Because by the end of 2024, the growth scare seems to have passed away. The US economy is powering ahead and inflation isn't slowing as fast as it was previously anticipated. Now add to this khichdi the tarka of Trump uncertainty. President-elect Trump is yet to officially take charge. The inauguration is supposed to happen in January. But once he does, if he actually unleashes the high tariffs on the rest of the world, as he's been talking about currently, well, inflation will pick up in the US because Americans will have to pay more for everything that they import. And if Trump goes ahead and gives more tax cuts for American corporates, that could be a positive for US growth in the short term. By the way, do watch the episode of The Bond Economist on Trump's impact on US, on India, and on the rest of the world. I'll leave a link in the description. So markets are now largely convinced that in the US, the 2024 theme of strong growth and high inflation is also likely to spill over onto 2025. And that means that the Federal Reserve will have very little scope to cut interest rates materially here on. Higher US interest rates, strong US growth will attract foreign funds out of emerging markets like India, and the foreign investors will dump our currencies to buy the dollar to invest in the US. So is the US solely to blame for the tanking of the Indian rupee? India's economy has also been leaking more dollars than it is collecting them. Now, India usually imports more goods than it manages to export. After all, we are addicted to oil and gold imports, and the goods we produce and export very often rely on imports of machinery and inputs that we process and then pass on. Bottom line, we import more than we export, and hence we have a trade deficit on the goods side. The situation reverses on the services side. Being a major global leader in IT and professional services, every month we end up exporting more services than we import. And so we have a trade surplus on services. But together, when we add the trade deficit in goods and the trade surplus in services, we still run an overall deficit. So on a net basis, we still spend more dollars than we earn. The problem is that this deficit has widened considerably of late. You can see that overall trade deficit in just the last 2 months, October and November, has been more than the combined deficit in the previous 3 months and in past quarters. So on the trade side, we are bleeding more dollars than usual. Now, typically, and I'm somewhat simplifying here, India fills this hole on the trade side by inflows from remittances and foreign investments. Remittances are usually not enough to fill the whole gap, so we end up relying a lot on foreign investments. But they too have disappointed this year. FDI, which is foreign companies setting up or acquiring companies in India on a net basis, has been dramatically low in 2024. And FII, or foreign investment in our stock markets and bond markets, have also disappointed in recent months. Yes, you can blame some of this on global factors, but it's hard to ignore the other elephant in the room, namely India's faltering growth. Domestic demand, especially from the middle class, is suffering. Incomes haven't grown quickly enough, increasing the vulnerability of the common man to inflation and taxes. Companies in most sectors are seeing this and are shying away from making large investments. The government, in its latest monthly economic update, has squarely dumped the blame at the RBI's door, stating that the high interest rates and a crackdown on personal loans and credit card loans has worsened the slowdown. If you haven't, please do watch the previous Bond Economist episode on an in-depth analysis of India's growth slowdown. The point is that most of the foreign investment in India comes with this innate belief in India's medium-term growth story. And while that is probably still intact, we have great growth potential. The fact remains that even a temporary fatigue or slowdown can spook investors and can make some of them question this long-term optimism. So we are leaking more dollars from the trade side. We aren't getting enough dollars to compensate for that from the foreign investment side, and the dollar has been generally stronger. This is a perfect recipe for rupee depreciation. So how has the RBI been managing and manipulating this depreciation? Well, conceptually, it's very easy. If RBI wants to prevent rupee depreciation, it can just sell the dollars it has in its reserves. As it sells dollars, it buys rupees, reduces its supply, and in the process causes its value or exchange rate to rise. So what's the problem? These rupees that the RBI buys, where are they buying it from? From domestic money markets, where banks regularly borrow and lend to meet their short-term obligations. So by vacuuming out rupees from the market, the RBI causes the cost of money or the short-term interest rate to rise, which is bad for credit growth and is a drag on the country's growth. So then the RBI needs to find ways of artificially pumping back rupees into the system to ease the pain. For instance, it can do what it did in December 2024, reduce the amount of reserves that banks are mandated to keep with the RBI, or the cash reserve ratio, giving banks more money to play around with and to lend to each other. It can also offer to buy government bonds from banks and in exchange pumping money into the system called open market operations. The RBI can also dabble in forex futures and forward markets. I won't get into the mechanics of it in this video as it gets pretty technical, but the broad concept is that instead of actually selling dollars now and causing a shortage of rupees in the present day, the RBI can commit to sell dollars in the future. So people may think that, oh, rupee could strengthen going forward. But again, these kinds of interventions also come with their own complexities. The bottom line is that manipulating the exchange rate is not simple. And it's not cheap. India's forex reserves are down by around $60 billion from the peak of around $700 billion. Granted that part of the fall is because a weaker rupee means that the dollars that we have in our reserves are valued lesser. But it also reflects the RBI selling its foreign exchange to keep the currency artificially up. And it may still not work. A central bank may burn through its reserves to defend a particular level of the rupee, but it can't withstand the pressure of traders and speculators betting against it, or as a matter of fact, the impact of a global shock that is not in its control, like an unhinged Trump tweet, which begs the question, is all this headache to manipulate the rupee really worth it? Well, for the government, it's often a question of PR. People associate a weaker exchange rate with a weak economy, and so a stronger rupee comes across as good politics, regardless of the economics. It also helps Indian companies that have borrowed a lot from abroad, who would face a financial crunch if the rupee depreciated too much, as they have to spend more rupees to make those interest payments. And finally, you can argue that an overly weak rupee makes imports more expensive, so imported inflation picks up. And it could be that for some imports like oil or food, it doesn't matter how much it costs, the country will continue demanding it. The RBI's estimates suggest that every 5% depreciation in the rupee adds around 0.35% to overall inflation. But it's also worth noting that core inflation, or the inflation ex food and fuel, is actually tracking much lower in 2024 at around 3% levels. Plus, we face the threat of more cheap Chinese imports being dumped into India as US-China trade tensions pick up and the Chinese economy struggles from its property sector-led slump. So high inflation from exchange rate route may not be a compellingly strong argument to defend the currency. In fact, meddling too much with the rupee can have side effects. Let's say a company imports oil. So ideally it needs to hedge itself or fix an exchange rate, because if the currency depreciates too much, then they would have to pay more for every dollar of oil that they buy. But if the company sees that the RBI is going to absurd lengths, buying and selling dollars and doing various financial gymnastics to keep the exchange rate stable, they'll be like, you know what, why should we waste money on hedging? The central bank is doing it on our behalf. But what happens when the rupee depreciates too much, even for the RBI to handle? These companies will be left with huge losses if they didn't protect themselves. Also, if India's key competitors are allowing their currencies to depreciate and we are artificially propping our exchange rate up, it's like pair pe kulhari marna. Because Indian exports will become more expensive. Remember how at the start of the video we talked about the real effective exchange rate, about how rupee can still be as much as 8% overvalued. So by not allowing the rupee to depreciate, we are doing ourselves a disadvantage. If an Indian car company is competing with a Chinese car company and the rupee hasn't depreciated as much as the yuan, well, our cars are going to be more expensive. So now you start to think, hey, is there any point in manipulating the rupee so intensively? And it seems that even the RBI now is coming around to this view. Now, the previous RBI governor, Shaktikanta Das, was a big fan of controlling the exchange rate. He was extremely proud of the fact that he had managed to keep the exchange rate stable. But now we have a new governor, Sanjay Malhotra. And since he has taken office, although he hasn't explicitly said anything about the rupee, we have been seeing the rupee drift higher. And markets have started wondering if this means that a regime change has happened at the RBI on exchange rate management, where the RBI is now okay for market forces to dictate where the rupee ends up rather than artificially propping it up. Note that before his exit, a key point of contention between Governor Das and the government was that the RBI was keeping interest rates too high. Do watch the Bond Economist episode on this. The link is in the description. And remember, if the RBI sells dollars in the spot market to stop the depreciation, then it sucks out rupees from the domestic market, and that raises short-term interest rates. So if the new governor, Sanjay Malhotra, who by the way is a finance ministry insider, is joining the RBI with an intention to lower interest rates, then this exchange rate control will only complicate his mission. In fact, if the new governor actually reduces the policy interest rate to tackle the growth slowdown, then Indian interest rates will trend lower at a time when US rates are likely to be trending higher. So the attractiveness of Indian rates will go down, which is also not a positive for the rupee. Of course, if the global environment changes, if the whole US narrative of high growth, high inflation gets disrupted, or if India's growth rebounds strongly, then this depreciation that we've been seeing so far may start to taper off. But for now, the rupee seems headed lower, and it looks like the government and the RBI may be okay to let that happen. For more such insights, like, share and subscribe to the Bond Economist.